Welcome to the Charlie Paparelli Show. I'm Charlie Paparelli. And we're here. The Charlie Paparelli Show is really all about entrepreneurs to help you to start a company. And if you've already started a company, to give you some tips and on how to raise money and maybe actually tips on how to manage that company and build into something very, very valuable, which I know is your goal. Is if you'd like to make sure you don't miss one of these recordings that I'm doing, is please go to paparelli.com and just submit your email. As a bonus to that, not only will you be made aware of every recording, every interview that I do, as a bonus, you'll get my Tuesday morning blog. But thanks for tuning in. And today's guest today is Scott Lopano. Scott is a principal at Tech Square Ventures here in Atlanta. He's also a principal at Engage, which is a corporate supported accelerator at Georgia Tech's Advanced Technology Development Center. And those two, Tech Square and Engage, are related, and we'll get into that in a minute. He is a graduate of the University of Pennsylvania, the Wharton School of Business. He apprenticed in investment banking at UBS in New York City, and then came down to Atlanta to join Tech Square Ventures and join the venture capital industry. I met Scott right after he came to Tech Square Ventures. Now I guess it was almost 6 years plus, 6 years ago, a little bit more. We actually met at a Bible study that I was leading at the ATDC, and Blake Patton, the managing partner of Tech Square Ventures, was one of the participants, and he invited Scott so that he could meet some new people and become part of that community. That was our first meeting. And then from that point on, I watched Scott basically build his career here in Atlanta as a venture capitalist and also to build his family. He moved to Atlanta as a newlywed. He was married for about a year, but now he has 3 children. And he has built deep roots in the Atlanta technology community. Scott is a part, really, of an elite group of next generation partners for venture capital firms in the Southeast. So you're meeting someone who is going to be somebody to be reckoned with as we go forward. Right now, he's accumulating a lot of experience that he's going to share with us today. Scott is intelligent, he's experienced, and I think he has wisdom beyond his years with regard to startups because he's seen so many of them. His key responsibility at Tech Square Ventures is to find those winning investments in this sea of applications that comes his way. So he is the gatekeeper for the venture capital firm. So today's topic is how to get past the VC's gatekeeper. And in this case, it's Scott Lopano. So Scott, thanks for sharing with us and with me and with our audience. I'm looking forward to this interview.
Yeah, absolutely. I'll do my best. You shall not pass impersonation.
Well, you really, I know it makes it sound like when you say you're the gatekeeper that it's a pretty ugly thing to be, but you're in business, to get to those right investments that make sense for your venture capital firm and the other people in business to try to find money. I call it shopping for money is what I call it, as they're out there as entrepreneurs. But why don't we start by you telling us a little bit about Tech Square Ventures?
Yeah, sure. And thank you, Charlie, for having me. Thanks for all those that are listening. And I hope this can be helpful in one way or another. But Tech Square Ventures, as Charlie mentioned, we are an early stage venture firm based in Atlanta. We really were founded in 2014 on the basis of 2 things. We wanted to really back entrepreneurs in the Southeast. We believe in this region as the fastest growing innovation ecosystem, and that there's a lot of opportunity and not enough access to capital, especially at the really early stages. And so we wanted to solve that problem and be a part of that solution. And then 2, that if there's anything we could do beyond capital, it would be giving our entrepreneurs access to customers and markets. And we try to make most of what we do at Tech Square, and certainly what we did when we backed and founded Engage in 2017, to be about providing that access to new customers and markets and helping startups and entrepreneurs scale their business. So we onto the engage piece and how that's
that's
related.
what I was going to say, because that second piece that you talked about there, or the second reason that they started Tech Square Ventures, which is access to customers, then this whole idea of engage came up. And that's ENGAGE, in case I'm not saying it so people understand it.
That's right.
But go ahead. Why don't you tell us about Engage and its formation, and what its mission was, and how it integrates with this whole Tech Square Ventures piece?
Yeah, it's a really unique part of what we do and how we do it. And actually, back to your original story of why I came to Atlanta. I came here because I believed in the mission that Blake had set out when he started TSV about this region of the Southeast, and specifically Atlanta. But I also thought that this unique fund and program and platform of Engage would be really special, and I wanted to be a part of it. And that was in 2017 when I came to Atlanta. So we launched it then in partnership with Georgia Tech, and at that time, 11 of the big corporates that you'd think of around Atlanta.
Well, what was the original idea, though?
What was the original idea?
Yeah, because, I mean, he had a fund. He had Tech Square Ventures, right? Where did this whole Engage thing come from?
Yeah, this definitely was more born to be a community and an ecosystem than it was to be a fund. The fund is definitely the mechanism. It's important. It is the business model. But what was really unique, what drove the CEOs of the corporates, what got Georgia Tech excited, was this idea of a future where many of the entrepreneurs in the entrepreneurial ecosystem knew the executives in the corporate ecosystem in Atlanta and in the Southeast, which historically has not been the case always. So our goal, number one,
was that a need for the corporate guys, that they really wanted to get into this very early stage innovation?
The story we always tell is that when Invesco was looking at digital asset managers, the first place they went to was Silicon Valley, and they called up the contacts they knew in that innovation ecosystem. And little did they know or think about what was happening in Atlanta as a fintech hub. And I think that's only changed.
And Invesco's located here.
Yeah, and
we go to California, right? Okay.
Entrepreneurs building companies here, and so now the idea is, based on Engage, you've got a founder that building a company that's interesting, that you can get insight and intelligence from, and maybe they're based in Atlanta, maybe they're based in the Southeast, but either way, we can build that activity, and those corporates can have that access to innovation here in their backyard.
But so if I'm a startup, I don't understand. Am I applying to, if I'm looking to get funding, am I applying to Engage, or am I looking for, the sort of routine funding method, which would be go to a venture capitalist and see if I could strike it up with him? So I don't understand, or help the entrepreneurs understand, how that works.
There is a little bit of nuance, and Engage is definitely something new and different. So we have the burden of having to explain that, which we're fine with. But the easy way to explain it is, if you're an entrepreneur launching a new fundraise and you need a lead investor, you should be talking to Tech Square's early stage fund.
Okay.
If you're an entrepreneur that is scaling rapidly and looking for enterprise customers and wants to make tweaks to your go-to-market strategy to make it that much better, and you see these corporates and you think, I'd love to land them as customers, you should be talking to Engage. And so sometimes those overlap, and I think the idea of our platform is that we've built it so that we can add that value one way or the other. But Engage is optimized for the corporate connections and the go-to-market strategy. And our early stage fund is optimized for writing your bigger check, being your lead investor, setting the terms, and doing all that kind of stuff.
So when I look at at Tech Square Ventures, that's a traditional venture capital model and has traditional, what I'll call limited partners, right?
Sure. Yeah.
Right. So you're going to have probably some very wealthy individuals, family offices are probably invested in that, as well as, I don't know, some institutional investors, I would guess, right?
Institutions as well.
So that's the venture capital model. So how is Engage funded? If I'm a fast growth company that's looking for access, give me a couple of names, by the way, of some of these companies that are involved in Engage, so people get sort of a.
Yeah. So from the corporate side, from the beginning, we've had Cox, we've had Delta, UPS, Home Depot. Most recently, we've added Honeywell, Coca-Cola has come on board, Wellstar. So you can see it's sort of a variety of different industries.
Is Goldman in this deal too?
Goldman Sachs is
Yeah.
is
So
an investor and partner.
it's a pretty impressive list. I know when I go to the ATDC and I see that list of companies, I go, yeah, that's pretty good. If as a who's who of
It's a
Fortune,
great group.
really a lot of Fortune 50s, okay,
Yeah.
that are looking for innovation. So it's unique offering to say, if I am fast growth and I see these companies and I say, man, I'd love to get into the
Yeah.
CEO level, you can offer that. But how is that How is that Engage funded? Is it Tech
Yeah.
Square
Well,
Ventures that funds it, or is it the corporates that fund it? How does it work?
yeah. Each of the corporations are the investors
Okay.
equally into Engage, so that for them again, the fund is very important. It's the
So that
driving
is a
business.
fund.
Correct. Engage
Engage
is its
is
own
a fund. Okay.
managed by Tech Square Ventures. That's the connection, by the way. So we are
Oh,
one
there you
firm.
go. Okay.
We're one firm with two products.
Okay.
Easiest way to think. And so we've got our lead investor product, our early stage fund, and we've got our programmatic go to market and corporate scale. That's Engage.
Is Engage? Excuse me. Is Tech Square Ventures also an investor in the Engage fund?
There's probably
Are
some
they
nuance
also an LP there?
but no, not in the sense you're thinking of it. I would say we're the fund manager. It's the easiest way to think
Okay.
about it.
All right. That
But
makes sense.
maybe in terms of Gatekeeper and helping your entrepreneurs understand, we're one team. So when I meet an entrepreneur, I'm meeting them under the context of, hey, is this a great business? Is it a good fit for either our early stage fund or Engage? So if you're talking to one of us, we're all one team and we're all working in the same building and all these other things. So in terms of the getting access to either fund, whether regardless of what your goal is, talking to one of us is going to get you there.
Yeah, but you're going to be more the gatekeeper, if you will. You're going to be first touch more for Tech Square Ventures than you will be for Engage. Is that true?
That is certainly going to be true going forward. In the past, it's probably been evenly split.
Oh, it was.
But
Okay.
yes, going forward, you can think of me more so on that early stage fund side.
So who's the Engage contact?
Yeah, well, so Daly Irvin, who's the managing director, is a great person to get in touch with.
Okay.
He leads the Future of Work working group. So any companies out there innovating on the future of work, they'd want to talk to Daly. If you are innovating in customer experience, you want to talk to Vasant Kamath, who's one of the partners at Tech Square. And then I'm data and analytics, as well as fintech and cybersecurity. So I got quite a few that I handle, but yeah, that's why. So I'm still
three small industries there. Yeah, that's really great.
Yeah,
I love
easy to understand too. No complexity there.
Now this is the second fund for Tech Square Ventures. Let me drill down a little bit more on Tech Square Ventures because that's what we're going to be talking about today. So traditional venture capital funds access is what we're looking to. So tell me, this is you're on Fund 2. Tell me a little bit. I think you joined when it was just Fund 1, right?
Correct.
Yeah. So why don't you talk just a little bit about Fund 1 because that's kind of where you cut your teeth on venture capital. So what was that about?
Yeah. Yeah, well, Fund 1 was small first fund, 8 portfolio companies. I would say, I looked at a bunch of different companies toward the end of investing out of Fund 1, and then really actually cut my teeth on Fund 1 of Engage, where we ended up with 43 portfolio companies over 3 years. And based on that model, we saw, 1,000 companies or so a year, probably more. To get down to that.
Interesting. So I asked you about Fund 1, and then you bring up Engage, and you talk about 43 companies versus the 8 companies. It's very confusing from this side. I just want to tell you that.
Sure.
So I'm an entrepreneur. So think of it that way, that we're talking to this entrepreneur. Yeah. So keep this into perspective. I know a little bit. I know a lot, in fact, of what you guys have been doing. So, but I don't want to run past this. I want to think about our audience and to make it clear for them.
Yeah. Okay. Yeah. All I meant was in terms
how big was Fund 1?
So Fund 1 was $5 million.
Okay. So really, I think it was originally set to be 10 million.
Yes.
And it wound up to be 5 million because it had so many limited partners. And then there was a change, right, which made it 5 million. So this happens to venture capitalists too. And so, that limited the opportunities that you and Blake were actually able to take advantage of.
Yeah. And the only reason I bring up Engage is because that was just launched. And so we were focused on building that as a platform. So much of my early investment activity was actually looking at the Engage Fund 1 companies from 2017 to 2020 when we launched Fund 2. So going back to our TechSquare Ventures, which is the main focus for today, we launched Fund 2 in 2020. And we've done 7 deals out of that fund in about a year.
What's the target for that fund?
75 million is the target.
75 million, which is, that's pretty, what I'm finding is that's pretty much typical second fund. So you'll have that 10 to 15 million up to 75 million. And then the fund 3 jumps to sort of 250 plus.
Yeah. If in a really good environment and if you do it right, yes, that's correct. I'm sure there's plenty of funds that don't hit that trajectory. I think we're excited about where that 50 to 75 puts us and our ability to execute on the mission, which is leading seed rounds for Southeast-based companies. That fund size allows us to write that $1 to $2 to $3 million check and be a lead in your round, and that's ultimately what we're doing.
We went through a period of time where these early stage investment funds moved up market, if you will, and became sort of what I would call really Series A or later stage, not seed stage, because there's less, if you can get a good deal at that level, and there's less risk, obviously, because they already have pretty good revenue, they got customers, they figured out their strategy, those kind of things. But what's happened now is there's a lot of people that are filling that space, right? So it kind of moves people back into seed stage again, okay?
Yeah.
And what I'm saying is you guys doing is you start squeezing out angel investors because you guys are coming in early. So because there's investors up and down the line,
Yes.
All right. So
in today's environment, you're squeezing on somebody no matter what.
Yeah, exactly. But there's so much money chasing a good deal, if you will, and the right entrepreneur. So you started as seed stage. And you're in seed stage. What does seed stage mean to TechSquare Ventures?
Yeah, that's a great question. So we look at it primarily in terms of milestones of your business. So where are you in the journey of your business? And for us, seed has pretty squarely been that period of time where you're iterating and experimenting on what your go-to-market strategy is, and you're trying to prove that you have product market fit. And this is a sort of high-level version. Product market fit's very hard to define in and of itself, but ultimately, if you are
how do you define it?
That's my number one thing. Every time I talk to an entrepreneur,
to you, "Oh yeah, I got product market fit." Then what questions do you ask to say, "Oh yeah, you do"? Let me ask you a couple of questions.
Yeah, usually it's kind of getting the full story. What's your expertise in the industry? So how well do you know what the market wants and what product market fit looks like?
Yeah.
Ideally, you can get some proxy with customers and the customer behavior, whether it's a customer call or the number of customers or how they're growing or what's the engagement, how often are they logging into your platform. So I want to know and understand customer behavior. And then ideally, it looks like the market is pulling your product into the market as opposed to you pushing it. And so when the first conversation goes toward, we've spent this much on marketing or we have this many salespeople just cold calling, that's an effective sales tactic. But what I'd love to hear is what was going on before you started outbound selling. How much of the market how much were you being pulled into the market? And so those are some of the ways that I try to assess product market fit. But it's
that's interesting because you're not asking because you can have product market fit as a services company. Okay. Meaning that, I'm a dry cleaner, right? Okay. I'm a dry cleaner. People have clothes. They need to get them cleaned. I have all these customers. Here's how it works. And you're like, yeah, but there's no growth there. What I'm looking for is where people are standing outside your dry cleaner for a mile long, right? They just can't get in the door because you are the only dry cleaner that does whatever this is, right? I want that guy.
Right.
That's
and it's so interesting. The challenging part and where where it's difficult as an entrepreneur is you have to be able to convey that part and the part of, but we've identified this way to solve this need that is more scalable, more efficient, than any other dry cleaner. And so that line of people out the door, we can serve them. It's not enough to say we have a line of people, because that if you can only ever serve 5, whatever, do 20 suits a day, then there's no growth, there's no scalability, there's not the path there. So you've got to have the outsized demand and the efficient path to scale. And that's the duopoly that's tough.
So that's product market fit plus the solution that can scale. Those
Correct.
are the two things that you're looking for. So,
Right.
Okay, so then what else defines this seed level?
Yeah. Here's a couple metrics that I find might generally look sort of normal as we're thinking about. Right now in today's market, it looks like a $2 to $3 million raise generally looks like seed, because you're usually burning about $100K a month, maybe $150, $200K a month, and you're looking to raise 18 months worth of capital. And I only say all that just to say, for better or for worse, for a gatekeeper like me, seeing something that looks familiar really helps. So when you see a company that's at 4 million in revenue and they're raising only $1 million and they're calling it a seed round, there's all these things going on for me wondering why. That's so different than what I normally see. So what you normally see in today's market is that $2 to $3 million raise, and a company might be somewhere between 0 to 500K in ARR, something like that. And it's a proper seed round. So we've got some traction, but we're certainly not at Series A. We're not at that repeatable, scalable go-to-market strategy where if you give me $10 million, I know exactly where I'm going to put it, and I know it's going to generate, X dollars of return. Seed is still experimental. Seed is still, I want to run these 7 experiments, and I'm not sure which one is going to work. I'm not sure what the outcomes are going to be, but I have a really intentional set of experiments I want to run, and I need 18 months of runway to do it. And I know that one of those will lead me to the repeatable, scalable go-to-market strategy, and that's how I'll get to my Series A. So for us, milestones is so much about where you are now and what you want to accomplish by the time you get to the next milestone.
Well, that makes sense. So when you talked about so I'm looking for 18 months of funding, right? So I have to cover this burn rate or this negative cash flow that I'm doing.
Right.
Okay. So if I'm still experimenting at seed level, I think you said from 0 in revenue to 500,000 in ARR. That's sort of a sweet spot for you.
Yeah, I think that's
okay.
A lot of what we see.
How do you, if these companies do seem to have this product market fit, okay, and they do seem to have, again, this scalability, if you will, to satisfy the demand in the market that you're trying to go after. What's the range of valuations, okay, that you're seeing?
Well, in today's market,
I should say what you're seeing, and then what sort of makes sense as a venture capitalist, okay?
Right.
And how you look at things, okay?
In today's market, you'll see a lot of things. Everything from a $1 million round at a $4 million valuation to a $10 million seed round at a $40 million valuation, just depending on which marketing you're in and what kind of company you're building. So it's very hard in today's landscape to have what a norm is. That said, even though that's the range, majority of rounds do end up looking like that 2, 3, maybe in today's world, $4 million seed round. And as you can imagine, a normal amount of dilution for that entrepreneur might be 20 to 30%. And you can back into what that looks like from a valuation standpoint. So we employ multiple methods for valuation. We try to understand what a multiple on revenue might look like. We also really try to understand where are you today and where do you need to exit, such that we and you are aligned on the path to the growth and path to that exit. So everyone's a winner. We call that the venture method, but it's just working backwards from your outcomes. If you're the entrepreneur, all you need to know about that is the bigger your outcome, the easier it is to get a higher valuation earlier, right? So it's just trying to help us understand what's the total market size and what's the potential outcome you're aiming for. And then also it's just that, hey, we need $2 million for 18 months and 20-25%.
Given that here we are in Atlanta, and I'm just like, can't believe what I'm seeing in some of these things. We're seeing like Sales Loft, that just sold now for $2.5 billion. Okay.
Yeah.
Around last year for Greenlight at a $2.25 billion valuation. Okay. Calendly at a $3 billion valuation. This is Atlanta. Okay.
Oh yeah,
ISS, the
it's
internet
Atlanta.
networking company, they went public. I don't think they went public, probably with maybe a $250 or $300 million valuation. And the big thing was IBM bought them while they were public at a $1.4 billion valuation. We're like, wow, that's incredible. Now it's not incredible anymore. It's not a big deal. It's like, I feel like we've kind of laid, I've been doing this for 30 years. So we laid this groundwork. And if we ever got hooked into a company that ever sold for 200 million plus, man, that was like a dream come true. And now everything is not even billion. It's 2 billion. So how many companies go to you and you say, well, how big do you think this can be? And they go, oh, this can be $1 billion. This could be a $5 billion company. Is everybody thinking that way now?
Yeah, generally speaking, yes. And I, at the same time, I would argue somebody like myself who's been cutting my teeth in this kind of an environment, and even though I've seen cycles, I've not really seen what it looks like when these kinds of valuations normalize and companies don't just snap their fingers and end up at $1 billion. So you're also working through a gatekeeper that probably believes that you might be a $5 billion company tomorrow, more than 10 years ago. So I think that's where the market is. So
more
you're getting
than
the
you would have thought 10 years ago, you're saying. Yeah. So
as an entrepreneur, you're absolutely getting the benefit that most of the market sees those same $1 billion companies and says, oh, we can do that. I'm a good investor. We can pick the right company and they'll be $1 billion company. So the whole market is benefiting from that. So that said, I think I hear it 110% of the time. And the reality is still that even though it's happening frequently, it's still a 1, 2, 3% chance that you end up as $1 billion company. So that said, we build a portfolio. We pick 20 companies and we're not going to invest in a company unless we believe they can be at least a $500 million company building worth value of $500 million. So will they all end up there? Of course not. But we have to see what the path is. Why do you think that you have the unique ability to go do that? And we've got to believe that that's possible. And so every entrepreneur should have a really good, solid lockdown story for why they think that that's the case for their company. And then really it comes down to finding the right fit with the investor that agrees with you. And I think my number one takeaway for any entrepreneur listening is that if you're really having trouble convincing that investor that you can be a big, valuable company someday, it's probably just not a good fit. I'm not sure you want them backing you, even if they did write you the check. So finding that fit with that investor who believes in your vision the same way you believe in it is a key.
When you're thinking as a seed level fund, what type of returns are you really looking as a multiple of your initial investment? Okay. What type of return, just to give entrepreneurs an idea what you really have to shoot for, because you're not going to have how many companies in this fund, this $50 to $75 million fund that you have now, Fund 2, how many investments do you anticipate making?
We'll make 20 to 25.
So 20 to 25 investments, and then you're going to have how many follow-ons? You follow of those. So you got 25 companies, let's say, and how many will you do a next round with, if you might, you see?
Yeah, it depends on the performance, but we hope a half.
Half of that. So 12 of those will get then follow-on money, because the other 12, they haven't hit the milestones to deserve the follow-on money. They're not, that follow-on money isn't a good investment. Okay. Then of those 12 that you did a follow-on for, is there room in the fund for another round?
Yeah,
I mean, you got to gas at that point.
We reserve 2 to 1, so it's kind of just depends on the check and all this stuff. But we heavily reserve. Yeah, we heavily reserve in the hopes that we can write an even bigger check the second time around than we wrote the first. We'll probably peter out from there, and if the company's doing particularly well, there won't be any room in today's environment. The next investors will want all of it, and so we have to fight to keep our spot. So it's a very situational. It's hard to say at that point, but yes, our
just
model
for entrepreneurs, it's good for them to see this. Is what you're doing. You're just saying, okay, so I'm putting in $1 today and reserving $1 for tomorrow, right? But
At
that
least,
dollar is really because I know that half of the people that I invested in will not be follow on. I really have $2 to now put in the next round. And I want to do that because this is lower risk capital. Okay. Because now we got something, right? Now we're out of the experimentation stage and this thing's starting to run. And that's when I
yeah.
want to double down if I will more than double down. Okay. In that case.
And of course you'll pay a higher price for that lower risk, right? But it's really it is a matter of doubling down where you see progress, but it's also a matter of maintaining a stake so that we're still a meaningful investor in the business.
So then go down to, and this is part of like when we talk about, you say, there's when we get to that second investment, if you're really doing well, not only do we want to put money in, but the next guy, the next big guy that wants to put money in, he doesn't even want to let us back in. And that's the point of you having terms in your first investment to make sure, right? And
That's
what
right.
are those terms called that give you the right then to invest in the next round?
Pro rata or preemptive rights.
Rights. There you go.
So absolutely. And really, our number one priority is building a great relationship with the entrepreneur such that they want us to continue to be involved. Because rights and legal documents can be amended. But yes, that's why the preemptive rights
it's funny. So you got an entrepreneur who's sort of, hoping that you'll invest in his first round. And then if he's doing really, really well, you're hoping he'll go to bat for you to allow you into his next round.
This is the irony.
Crazy, doesn't it?
This is why I was laughing about the gatekeeper thing, because there's this perception, and it's reality in some cases, that we have so much power because we decide whether a company, gets invested in or not. But the reality is that, that dynamic flips really fast. And so you really want to build a strong partnership where regardless of who has the power, you've got some equilibrium and a place to come with that entrepreneur, and you have a place to come with your investor to say, here's what's going on, right? Regardless of the power dynamics. Here's what you need to do.
It also has to do with it also has to do with the person you're investing in, right? Do they share the same values that you share, right? That you have, all right? Because if you don't, then the least common denominator is always money.
Yeah, right.
And so, if this guy doesn't share your values, doesn't value the relationships that you have, that you were a first investor in, and then, you're getting to this next deal when it's working, you'd say, hey, man, I'm sorry, but money's money, right? That's what it comes down to. It's not personal, Scott. It's just business. Meanwhile, you got cut out and you put in the experimentation money.
Yeah.
And to you look and go, that ain't fair, man. That's just not fair. Give me a second bite of this apple now.
And it happens, right? But I think what we try to do exactly right is just we try to be as transparent as we can about our values and how we look at investing and being a partner up front so that we find the right people to partner with, because they're going to, hopefully we'll gravitate toward the right people. They'll gravitate toward us, but it doesn't always work that way.
Well, this whole conversation started with me saying, when you put in that initial seed money, what type of return what a return expectation as a multiple of your investment, do you have on that initial investment to make your fund work,
Right. I would say 10X is the common moniker. So we've got to believe that there's a 10X potential return on our initial money. The absolute winners that start returning funds that also we need are really 20 and 30X, which is sort of crazy in today's environment, but it's happening. So
you lost me on that. How'd you go from 10 to 20 and 30?
We have to believe you can be at least a 10X. But
that's the floor.
That's the floor.
On the initial investment.
So back to the entrepreneur. If you're raising a $2 million round at a $10 million valuation, you've got to tell me how you can be a $100 million company. That's the simplest way I can kind of break it down for people.
Perfect.
Knowing that is just the baseline. So 100 million would be, an okay outcome, right? Whereas as you talked about, these companies selling for 2 or 3 billion, that's the 20 and 30X scenarios where you really, as a VC investor, you have to have those in order to raise another fund. So that's
So in this
back.
fund, you have to have at least one unicorn
Yes,
to get to fund 3.
correct. That's a good way to, or we have a bunch of $500 million companies, which doesn't ever happen that way. It always
Right. So
happens.
right, exactly. That's what happens. So you wind
Yeah.
up with you wind
You'll
up
have
with the 50
outliers
million, the
one way or
100
the other.
millions, and the couple of hundred millions, and then you got the 2 billion, hopefully, right?
That's right.
And that basically is what makes the fund. Okay. I
That's
mean,
right.
great returns. Everybody is just happy as can be. And now they're saying, I trust that you could find another $5 billion company because those
And I
are
think
100-time returns.
right. Absolutely.
So if you
And
say
now,
if I get to 100 million on this money I put in, right? That's a 10-time return if I put in 2 million, right? If I go to a billion, okay, what's my return there? Okay, now it's
well, you're saying if you go from 100 million to a billion.
I put 2 million in, I get a 10-time return. Okay,
Yeah.
that same 2 million, if it's $1 billion company, what's my return?
You're talking about 100x?
Well, now
Or
I'm going
20x?
from $100 million valuation where I'm getting a 10-time return. If I get to a $1 billion valuation, now I got a 100-time return.
On the original money.
Yeah, original money. That's right.
Yeah. But
So this is just
also
to put things into perspective on what can happen in a fund and why you get into this game and why it's so important that those multiples work. You're not a mutual fund company who's investing in public markets looking to achieve, a 12% return or an 8% return.
Right.
Okay.
Right.
On low risk investments. In other words, very highly marketable liquid investments. This is, man, I'm into the end. Okay. Whatever the end looks like.
20% plus.
Yeah.
Yeah.
Is that why when you raise this money from these limited partnerships, the limited partners that are in fund 2, is that the expectation for the limited partners?
Yeah. Well, I think the reason I came up with that number, top quartile fund, is generally a 20% plus type annualized return. So if you stack that up against your S&P 500 versus real estate or other private equity securities, 20% is based on the risk where you need to fall to make sense in a portfolio. So that just goes back to the easiest way for an entrepreneur to think of all this as multiples. So it goes back to the 10x multiple is the baseline. 20 to 30x is really where you want to end up, knowing, by the way, that there's dilution, there's liquidation preferences. So just because a company exited for $1 billion or 500 million doesn't tell you the whole story. So the most conservative way to think about this is just the simple path of 10x first. And then really what I ask back to I usually step out of a lot of the quantitative conversations and I go back to milestones and I go back to category creation. So those companies like a Calendly and others that have carved out the billion plus, SalesLoft is another good example, created a category. And so it's really step one is what's your path to the 10x, which is the worth 100 million. And you've not necessarily created a category at 100 million. And then from there, what's your path to creating a category? And those are, if you can tell those two things in a first pitch, and you generally get the other investor on the other side of the table excited about those two things, you're in a really good spot.
That makes complete sense. This whole idea of creating a category is what is how you actually get to $1 billion plus valuation. Anything less than that, you didn't create any value less than that. You really didn't create a category. You might have created a big business, but it's not a category. So you don't get these category multiples, if you will. Right.
That's right. And I think what you're seeing today is the leading later stage investors might invest in 5 different companies, all trying to create that category, right? So one of them will win. But the idea is that they weren't even going to write that check unless they looked at that founder and that business and thought, you can take this and go create a new category. So that's where those, really kind of crazy high momentum rounds start happening, where you go from 200 million to 500 million to $1 billion in Series B and C and D. That's because you found a way to tell your story such that this is a new category that we're creating, and I just have to run faster than these three people next to me to get there.
Well, let's get back down to earth again then. Get back to our seed investment here. Since you got us all the way to Series E investing so quickly there. I love it.
Yeah.
But, I think, as a qualifier coming in, when I'm looking to, as a seed level, so I got from $0 to $500,000 in ARR, okay? You're probably looking for somebody that has more than 100,000 or 120,000. I mean, you got to be doing more than $10,000 a month kind of a thing. And you're on your way that I can see that can turn it to 240 or to 360, pretty quickly.
Yeah.
So then it gets your attention. But the next question you're really asking is, well, how much money are you looking for? And they go, well, my burn is $150,000 is $100,000 a month now. It's going to go up to $150,000 a month.
Right.
So if I really raise the 18 months, I'm thinking I need $2.6 to $3.2 million I need to raise, or whatever the number, right? Something like that. And you go like, that sounds reasonable to me. Now, your first thought is, they're thinking, but my business is worth, $50 million. And you're like, okay, let me just start doing the math on this, right? And the math gets ridiculous quickly. But if I say, it's a $10 million valuation, like you talked about, immediately you have to be a $100 million company for me to justify this investment. I need to see that that's going to happen. At least that's going to happen within some reasonable time frame.
Yep.
So now I'm looking at this entrepreneur and I'm saying, can he do this or can she do this? And then is there a big enough market for this? Is there market pull? Look at all of the questions you're asking that they're not even thinking about yet.
Right.
Like, what are those questions that they should be thinking about so that they think like you?
Yeah, that's a great question. I think, back to your original point, if first step is, do I sort of believe that this is a unique or interesting opportunity that fits with our thesis? So if you're pitching like you said, a dry cleaning services company, then I already can tell you, regardless of whether it'll be $1 billion dry cleaning company, we're probably not a great investor, so it's not a fit.
Because it doesn't fit your thesis. And you need to know, entrepreneurs, that every venture capital firm and hopefully every angel investor, even who's serious about things, a professional angel, has a thesis. There's things he invests in and things he doesn't. All right. Go ahead.
Some are more defined than others, right?
Yeah.
But either way, you have a sweet spot. Maybe even don't call it a thesis.
Go ahead. So go on.
Some might say it's not a thesis-driven firm, but they have a sweet spot. And so if for us it's enterprise, and it's because we know we can help there, right? And it's B2B software and marketplaces because we know those business models tend to scale and et cetera, et cetera. So we have a sweet spot and it's on our website. I tell entrepreneurs all the time, go to the website. And if they don't put it on their website, go look at their last 5 investments. It's pretty telling. Yeah. So even if they say on their website, I love investing in lamps, but their last 5 investments were robotics companies, and in your lamp company, then don't listen to the website, right? So I definitely encourage doing a lot of homework ahead of time so that you as the entrepreneur don't waste your time on a bunch of firms that might talk to you, but ultimately you're not in their sweet spot. So I think if you as the entrepreneur and the investor can feel out, is there a sweet spot fit here? Step 1. Step 2 beyond that is we go right to the question of, is this something where, assuming we're talking about a traditional seed stage type investment, can you get that 10x type return? And if it's clear from the front that you're thinking you're a $50 million company today, then I have to think, can you get to 500 million? As opposed to if we think it's a more reasonable 2 to 3 million on reasonable dilution, that's a 10-ish whatever type company, then you think about 100 million. So the math in my head, the questions are very different because to be at 500 million, even in today's kind of crazy market, you've got to have the category creation potential. So you've jumped from one question straight to the second question. The first question is just, can you scale and find a unique pocket of product market fit that you can take advantage of that? That's a 100 million type company. And I have a series of questions that I go through to try to figure that out. So that would be the second set of questions. And then ideally, you start talking about the third set of questions, which is if I'm sort of with you on that, on how do you get to 100 million, how do you how do you get to $1 billion or 500 million, et cetera.
That makes sense. That makes sense. I love what you say, the first thing and most important thing you can do, and this is true with selling, if you're selling anything, including stock in your company, which is what they're actually doing. We talk about raising money. Raising money is simply selling stock in my company. I have to sell whatever I have to somebody who's a qualified buyer. So think about VCs as qualified buyers, right? You sit there and say, what do these people buy? Okay. And if they buy robotics and I'm not robotics, I can talk to this person all day long till I'm blue in the face and they're not going to be interested in what I have.
Yep.
So I think that is so important. And that's something that I do see doesn't happen. It's sort of like from an entrepreneur's standpoint, money's money. They all got money. They all got money.
That's right. And we, back to our original part of our conversation, is there's more money in the system than ever before. So it goes back to, how does that firm differentiate themselves? How do they add value beyond the capital? And that's why we believed in building Engage in the platform for go-to-market expertise, because we wanted that to be our differentiator. I'm sure most firms have that version, their own version of that. And you got to figure out what is the value add beyond the capital that this investor brings, and is it what I need for the business at that point in time?
So how many of these companies come your way that are looking like how many?
I think
just give me the bigger numbers first. Like how many companies send information to you, annually?
Yeah, we probably see at the very highest level about 1,000 companies a year, if not more. That's I'm sure that's missing probably half the companies that we see in terms of lists and everything else. So, and it's a variety. I mean, in terms of just inbound, I'd say I field 200 inbound emails a year, 300 of entrepreneurs just sending me information about their company.
This is just this is cold inbound email.
It's cold. This is cold. Not a conversation.
No referral, no nothing. They just say like, "Hey, I got a great company, Scott."
Just info@techsquarebventures.com, right? Bam. And then of course there's accelerators and pitch competitions and warm introductions, and there's 8,000 ways that companies could come to us, but we see quite a lot. And then and again, it goes back to 50% of them just aren't a fit to what we look at, and so that's a quick decision. And then the other 50%,
I thought it would be higher than that. 50%, only 50% is not a fit.
Yeah, maybe you could look at it as about 70, but when you really think about especially when we're TSV and Engage, there's a pretty broad mandate for Engage. And so at the end of the day, it's worthwhile looking at a pitch deck, talking to an entrepreneur to figure out all those other facets. Hey, is this scalable? Do they have product market fit? You can't tell that from a cold email.
So we don't get confused, okay, and make this confusing. Let's just kind of stick to TSV. Tech Square Ventures. Okay, let's kind of take Engage off the table because I think that this is complicated for the listener. So let's kind of keep it straight up venture capitalist. Okay.
I think fair enough. So probably in that sense, it's probably more like 70, 80% are not a fit right up front based on our narrow. I mean, we invest in the Southeast. If you're not a company based in the Southeast, then it's a very high bar for us to invest. So there's got to be something else there for it to make sense to have a conversation. So
geography is one thing. Stage, right, is another.
Stage is another. So if you're asking for $10 million, $20 million, then you're past us, and that's great. Good for you. But we're not going to be a good fit for you. Similarly, if you're idea stage, I've got this great idea, I need a partner. That's too early. So there's a stage fit. There is a business model fit. So if you're building the next Instagram or something of that sort, social networking, then it's not going to be a fit for us.
All right. So you're B2B and it's software?
And software, but we also do marketplaces and we also do hardware software mixes like robotics where there's a software layer. So we're actually we're broader than I think might be typical on that front.
Yeah.
And then it really just comes back to the growth potential. So is this if you're growing 50% year over year, there's got to be a really compelling story on why that's going to go from 50 to 300%.
Mm-hmm.
And that's probably the harder one because it's not obvious up front, but once you dig in and you find out what the growth is, it's going to be a very uphill battle for us to push that one forward. So those are some of the.
So can I find? So you just kind of listed all of those sweet spot criteria, if you will, for what's going to be of interest to you. Is that something that I could, if I looked at your website, I would be able to discern that?
Yeah, you should, and we're actually working on our website. But yes, even in today's version, it's on there. B2B marketplace.
And so if I call you or send my business plan via info@techsquareventures.com, I'm wasting my time. I'm wasting your time, and I'm wasting my time, right? I mean, I'm not a fit.
I agree. Every once in a while, maybe every once in a blue moon, something pops through that for whatever reason I could be helpful. Maybe you're not a fit, but I know this other investor I just hopped off the phone with that would love to take a look at this and I can make an introduction. But that is very rare. So most often when we're fielding those inbound emails, it's like really quick screen criteria. Is this a fit or not a fit? So yes, as an entrepreneur.
So that when that email comes in through info, okay, and you look at their business plan or whatever it is, you're going through these criteria in your head and you're saying, the guy's in New York. We don't invest in New York, right? He's out. Okay. You're looking to say, to find that one X box that says, I can say no quick to this.
Yeah. I mean, when you get 10 or 20 of these a day on top of everything else you do during the day, you've just got to be able to say yes, no, yes, 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 no, 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 and move through it. So,
then what happens? So if I make that initial screen.
Yep.
Okay. So I get through the initial screen. First of all, you said that we were talking about the 200 to 300 emails that just come in cold through info@techsquareventures.com. Like you said, you have referrals that are coming in that have to be handled actually differently.
Yep. Because
now you have some investor that you know or some other VC that you want to stay friends with and all that. You can't just you got to treat this this inquiry a little different because you don't want them to go back to the referring source and go, what a bunch of jerks, right? Guy never even returned my call. Okay.
Yeah. We got to keep the relationship strong. Yeah.
Right.
So there's a lot of different ways that we see the companies and different ways we have to handle those leads. Yeah.
So we
get some from our corporate partners as well.
Oh yeah, that's right. You got the corporate partner. And of course, a lot of these partners, that you have, these people that are surrounding you, they're not as in tune with your sweet spot as you are. So they're basically looking, somebody comes to them and says, hey, I'm looking for money. And I'm sure they go, oh, you should go to Tech Square Ventures. They have money, right? I mean, because I'm looking to just help the guy. And here I am. I just created another, in effect, info@techsquareventures.com. But yet, if I send this person to you because you know me and you say, well, he should know what we do. Yeah. You're going to listen to this guy and maybe have a conversation with him even.
Yeah. Well, and that's all part of it. And that's, something we're more than happy to do because those referrals can be really helpful as well, where they might say, hey, I've worked with this founder for 15 years and this is their character and this is the kind of way they push through adversity. I can't ever tell that any other way through a pitch deck, right? So referrals are really important. They can be a great source. And also don't forget, we go outbound to find entrepreneurs. So, and not necessarily everybody does this in the same way. We have a pretty unique way of identifying themes that are really interesting investment criteria in markets. So, in data and analytics, I'm looking at data virtualization right now as being an industry, if you will, a sector. And we will scan the whole US for the top 10 startups tackling data virtualization, and we'll go outbound to them. So we'll send cold emails. So we're not always just,
how do you even find those guys if they've got to fit your criteria again, $0 to $500,000 in revenue?
Yeah, it's obviously you've got Crunchbase and PitchBook, which are generally lean later stage. So we'll look at Product Hunt, we'll look at G2, we'll look at product feedback sites, we'll find really we'll know what entrepreneurs are in that space and are leaving companies to go build new companies in that space. So there's no good science to it, but the art is something we take seriously in order to find companies that are already convicted in their industry or their sector. And so we can go to them and say,
inbound and I have outbound.
Correct.
And then you probably have industry analysts too that you're probably working with, saying, have you heard anything new? Anybody new? Anybody
Yeah.
young? Anybody got started that caught your eye or any of that, right?
Yeah.
So let's just step back for just a second and tell me what the process is at the highest level, okay, sort of milestone type things, okay, for that Tech Square Ventures has from initial contact to, funding the company. So I've signed the purchase agreement and went from there.
Term sheet or purchase agreement. Yeah. So step one, let's just assume it's highest level, whether it's a warm or cold intro. Past that initial screen, are we a fit? Do you fit within the sweet spot what we're looking at?
Right.
If you do, then there's usually a series of conversations. Pitch decks are shared, maybe early stages of a data room, so that we can understand more of the intricacies of the business and answer that question: is there a path to $100 million business here? And I'm really speaking high level, right? Because then you do a series of more meetings.
Which is what I'm asking for. I'm saying if you give me the steps, there's probably 5 or 7 steps. You follow me?
And this is usually all with somebody like myself or whoever you made original contact with, right? It's either a principal, it's an associate. If it's a partner, it's the partner that you made direct contact with. So you're usually working with one person at this point, trying to get them to believe in you for the 100 million. Is this a $100 million business? And then there's is this a is this $1 billion plus type business? Once you have good conviction on that, our process at least is that whoever that lead is puts a one-pager together, brings that to the whole investment committee to start talking about it. Here's what I'm working on. It's a really interesting company. Do you have anybody I can call? Do you have any feedback for me? Any interesting questions I should ask, et cetera? So then it becomes a bit more collaborative effort, but you're still working with that lead. As the entrepreneur, your goal is still to help that lead tell your story internally. And then once you get through that process and they start, presumably they're going to start asking for a lot more information. Mm-hmm. So they might look at your pipeline. They might look at your pro forma and financial model. They might try to understand what your current customer list is. They might have a customer call or two. They'll probably hopefully do market sizing, competitive landscaping. So this is the whole process of building conviction and working for us toward a memo. That's sort of the next, if you're an entrepreneur.
Would you call that due diligence?
It's sort of diligence, but due diligence is typically reserved for more legal oriented and IP and the sort of end of the process.
Yeah.
So we would say we're in diligence though. So it's a little bit of a nuance.
Diligence in general, but it would be basically diligence could be around forecast, market size.
Customer behavior. So if you have cohort, how your customers act, churn, all that kind of stuff. Trying to understand, again, really answering that product market fit milestone question. Are you?
The other thing that's
in some companies
this time is, again, are we still with the one person that I'm in contact with?
Generally, okay. Yeah, we might at that point.
What you're doing is you're actually building a relationship also with each other, right?
Yes.
Do I like Scott? Do I like because Scott's the only guy I know at Tech Square Ventures. So Scott is Tech Square Ventures to me. And then Scott's sitting there going, is this our kind of guy? Or is this our kind of entrepreneur? I'll say it that way. Okay.
That's right. And so you're building that relationship and you're trying, as the entrepreneur, you're trying to get that person to be able to tell your story internally. Now you might get introduced along the way to others. That principal might bring a partner into the deal to help him with some of the diligence. Right. That partner will definitely be brought in eventually, but when you choose to do that differs based on the deal. But the big milestones you're looking for are: did you pass initial screen? Are you talking about this with your team, right? Like, is it just me and you talking, or are you talking about this with your team? Did you create a memo? So once someone's created a memo, that's a lot of effort on my side. I take very few companies into memo stage is all I'm trying to convey.
What does that mean? Create a memo.
So that's past the one pager. One pager is like, this is a relevant enough opportunity to discuss, and it could be interesting.
And that's the first time.
Sorry, I just lost your sound. Can you hear me?
I'm sorry. What I said, I hit my microphone. What happened is, what I said is, when you get to the one pager, basically, so I do my initial screen. I got this. I see that this can be a big enough company to keep our interest. Okay. Right. Thirdly, I do this one pager, and that's the first time that anybody else in the firm really hears about this thing from me. And so Correct. They say, okay, now it's on everybody's radar, although
Right.
way out in the hinterlands on their radar. And they say, yeah, it sounds interesting enough the way you've talked about this. Here's what you need to find out to go further with this. Then I go into my diligence as Scott. And through my diligence, I say, this is like feeling right to me. It's checking all the right boxes. It looks like it can be a company that fits with us and has the kind of investment profile we're looking for. So now I say, okay, I got one. I'm going to create a memo.
Correct.
What's a memo?
Yeah. Well, actually, one good resource for your entrepreneurs out there, Bessemer Venture Partners, on their website, they have memos. I'm sure they're redacted in some way, shape, or form, but they're supposedly the original memos written for PagerDuty and I don't know, like at least 12 of their.
But this is something that's done internally. This is not something that's done by the entrepreneur. So what is it that you do internally? What's in a memo?
I just wanted to give you a resource. If you go there, you can look at that, pull it up, and
Bessemer Ventures. Okay.
Yes, it is a memo. So if you're wondering what a memo looks like, that's a sample of one. Okay. Ours probably looks similar to that.
Well, I think it's interesting that a memo is going to be something that, if I understand it as an entrepreneur, then when you're doing your diligence, I need to know this is what this is leading to, right? So you need to cover all these things with you. Right.
Exactly right. Exactly right. And what that person, that deal lead on the investor side, chooses to focus on for the memo, those are really good questions for you as the entrepreneur to continually ask. Hey, what are you working on? What are you struggling with? What are your key questions right now? Because you don't know. Because the way I do a memo is different than the way Joe, Schmo, and Sally does memos, right? But on the entrepreneur, you can always be in front of them going, what do you need? What are your big open questions? What are your big hairy questions? So that you can keep pushing them forward or figure out it's not a fit. But they owe that to you, right? And anyway, so our memo, call it 20 pages roughly, and we're going to cover the main criteria. So team, first and foremost. Our three criteria for investment is team, market, and timing. So team is very big, especially at the early stage and seed stage. Market kind of splits into two. What's the competitiveness of the market and what's the size of the market? And a very large competitive market is potentially okay. A smaller but completely uncompetitive market is potentially okay. Ideally, it's a massive market with no competition, and you rarely ever find that. But those are the dynamics you're playing with when you talk about market. And lastly is timing. And the joke that Blake always likes to use is, we all know that autonomous vehicles are part of our future, but where and when to invest along that technology stack is the hard part, is the when. So timing is important too. And I think that is something an entrepreneur can uniquely do in their interactions with somebody in an investment team. Why now? And I think that's missed a lot of times. Hey, it's a great business. You should invest in it. Well, in most markets, IoT, whatever the market might be, people have been building startups in IoT 10, 20 years ago, and they will continue building it. Why now? Why is your solution uniquely positioned to grow incredibly quickly in a short 5 to 7 year time span that now is the time? Another good example is AR and VR. You get pitched a lot of companies in virtual reality. If you know what happened with Magic Leap, you've seen a lot of people get burned in virtual reality. So why now? Why is now the time? What is it about the enabling hardware? What is it about adoption of VR for consumers? Why
But
now?
You're saying that that's the entrepreneur is going to convince you of that. Is that true? Every entrepreneur thinks that I have the perfect timing. I mean, everyone. I know that because I've dealt with them for 30 years, right? So when is it your responsibility? Here you are writing the memo. You have to stand in the gap and say, I believe this guy this time.
Right.
This virtual reality, this is going to work. Now's the time.
Absolutely.
What gets you to that point? What gets you to that point? Or is it something that you already know or have already decided on before you're even talking to the entrepreneur?
Yeah, I think it depends, I guess. So half the time, maybe it's half, probably 70-30. 70% of the time, because we're generalist investors, we don't know going into the conversation. That would be, you're the industry expert. You're going to know way more than we're going to know. 30% of the time, back to our outbound strategy, we do know because we've done the homework. We've looked at other companies. We heard from our corporate partners. We've got this really unique insight that tells us that now is the time for virtual reality, for virtual workspaces, for instance. And so once we stumble upon the entrepreneur, we're like, I know, you're right. This is the time. And that's great. But that doesn't happen all the time. And 30% might even be aggressive. Maybe it's 20% of the time. The other 70 to 80% of the time, we're trying to you have to build the conviction in us that now is the time. And I would say that the burden on that entrepreneur is to lead you to that conclusion, not to, there's no amount of passion. I mean, I have to see the passion in your eyes, but back to Charlie's point, of course you're passionate about it. You would not have quit your job and sunk your whole savings into this company if you didn't think the timing was now.
Right.
So what I hope to see is that you say, hey, you should go talk to these people. You should talk to that person. Do your homework over here. Check this reference. And then the reality is that whether an investor wants to admit it or not, most of the time their conviction is because they keep hearing it over and over and over from everyone they talk to. I went and talked to this guy, went and talked to that gal, and everyone's saying the same thing. So it's less about how much the entrepreneur is doing to convince you of the timing and more where are they leading you to go do your homework.
Now, so you create this memo, 20 pages. So that's quite an investment of your time, more of your time, okay?
Yeah.
And this goes to, who'd you create the memo for?
Yeah, the investment committee, which, for TechSquare, that is our partnership and the investment team. So
this is the sixth step in the process is what I've got it as. Okay. And this is present to the investment committee.
Correct.
Okay.
And at that point, your deal team lead is fully convicted because they're putting their neck out on the line, bringing this, taking an hour and a half of the investment committee's time, writing the 20-page memo to say, I want to do this investment. I think it's a good investment.
Deal team?
Investment team. And then our partnership that's the investment committee.
But who's the investment team? I thought you were the only guy writing the memo. See, up to now, you were doing all the work. Okay.
There's usually a deal lead, which is one person. And then there's the investment committee. And occasionally you'll have a deal team. So I might be working on it with a partner or with another associate or an analyst, especially bigger firms. You'll definitely have a deal team. You won't just have one person. Smaller firms, you have one person. So it just depends. But there's a big difference between between a deal team and an investment committee. An investment committee, most firms have it. It's very formalized. There's a process for voting and agreeing and consensus. And these are all questions you should ask your investor as you're going through the process. Hey, if you bring this to investment committee, do you need unanimous vote? Do you need majority vote? And they can tell you these things. So every firm is a bit different.
So how does that impact me? I mean, so if I think it's like when you talk about voting, if I need a unanimous vote versus a majority vote, how does that make, I'm already down the line here. I mean, am I asking a question in the before you write the one pager? You follow me? I mean, how far back do I go?
I would ask that question when you're deeper into the like step 4 or 5. I wouldn't bother with those.
So I'm sitting here and I find it takes a unanimous vote. Does that mean I'm thinking, my odds just dropped?
It maybe, but it depends. The only reason I say that is because you can pair that with your own context. Let's say you pitched the whole investment committee. You came in person or you did a Zoom, and in that investment committee, 2 of the partners were visibly excited. They were just psyched about it, right? Yeah. And they're asking you all kinds of questions. And then one other partner was like totally not interested. And you know that it's just a majority vote. Maybe you still feel good about that opportunity. If you know it's unanimous, maybe you should be spending your time with other investors. I don't know. But the point is,
all right. Well, that's what I'm asking you. Why would I ask that question? That was because that's the first time I ever heard somebody say, as an entrepreneur, I should ask that question. Okay. So how does this, in presenting to the investment committee, how often does the investment committee meet?
I guess once or twice a month.
Once or twice a month, okay. And then they're going to, so Scott and whoever else shows up, with could be partners showing up with their deals, right? And
Correct.
So you put the memo out to everybody before the meeting, so everybody's read the memo.
Yep.
Then what? How does it proceed from there?
So then usually if you're the deal lead, you explain why you're excited. You go through a summarized version of the memo. You definitely cover your key thesis points and your key risks. Typically, you would propose what you think the deal should be. Is it $2 million? Is it 2.2? Is it 3? Yeah. At what's the valuation you plan to propose? If there's any unique parts about the structure, they should all know about that. And so you say, I want to do this. I want to invest in this company, and here's the deal I want to propose.
Does at the investment committee, do you ever bring in the entrepreneur to the investment committee to present to the committee?
I would say step somewhere between one pager and memo. You often, for us, we definitely always have the entrepreneur pitch to our investment committee because we're very team oriented. And so we want everyone on our team to know and have heard direct from the entrepreneur about their vision, because we're buying into the entrepreneur's vision. Like when we say yes to a check. So
you're not going to write a memo until this guy or gal has presented to everybody else. Because if you see that they're kind of cold with it, I'm not going to put time in for 20 pages and push this thing through to the investment committee and everything else. So they can, the entrepreneur can in fact lay an egg sometime between the diligence and the memo, right?
Yeah. The two most common places that deals fall apart is the one pager and the pitch to the investment committee. If you get to a memo, it's pretty clear that you've got a good reason to come to that investment committee and explain your conviction. Some deals don't make it. Some term sheets happen and don't get signed. I mean, deals fall apart after committee, but it's much more rare. Is it
rare for somebody with your experience? You've been doing this for quite a few years now. You know, you've put together quite a few memos, I would think. Okay. Yeah. Have you, do the memos get shot down? I mean, by the time you write a memo, are you pretty sure this is going to go through? Because you seem to be betting, once you write a memo, you're betting your reputation within the firm.
Yeah.
On this recommendation.
Yeah, it's definitely greater than, you're not taking 50-50 shots on this kind of thing. Like you feel like you've got at least a 75% chance of this happening. Okay. But I would say in my experience, probably 10 or 20% of the memos that I bring don't get the votes they need or don't move forward for whatever reason. I've brought memos that I've gone and asked more questions and done more homework and then changed my recommendation. So it doesn't always have to be. So
80% will, if I'm going to the investment committee as Scott, I know I got an 80% chance, maybe a 90% chance they're going to agree with this and they're going to go ahead. Okay. To the next stage. But
based on current data.
What?
Based on current data. Yes.
Okay, good.
That will only get more and more competitive as we grow as a firm and that kind of stuff. So that number probably for a mature firm looks a lot lower, but anyway.
Really? You think it can get down to 50-50?
I think if you're a firm like a Bessemer and you've got principals all over the map and they're all bringing deals, and you can only do so many, I bet you that gets much lower. Yeah.
Yeah, it makes sense. That makes a lot of sense. Okay, so, but in your case, it's 10 to 20% sort of denial rate, if you will. And you say, for whatever reason, give me a couple of reasons.
Yeah. We actually had one that's more recent in my mind. And it actually came down to team. We had reservations on the team that we couldn't put to rest. And I think it was, and usually what ends up happening is it's a combination of things. So it's rarely ever that there's one part of the investment that doesn't add up. It's that you've got this culmination of risks that continue to pile up on each other, and it makes it too difficult to go forward. So in this case, it was these reservations about the team, the overall technology. The more we dug in, the more we talked to customers, everybody referred to it as, we just love their service. They're highly attentive to us. You know, they basically custom built this for us, et cetera. And sort of these indications that it was not as scalable as we hoped it would be. Anyway, so they added up. I think usually if you're asking like, what are the typical things? It's pipeline. We dig in more into pipeline and understand what looks like a big pipeline and what really is the, current pipeline. It is, we learn more about the team and there's some reservations there, or it's, we've talked to customers and we're hearing things that, either don't line up to what you told us or give us pause and reservations. And those are only things that.
But it's interesting that what it's really going to come down to is there's going to be these little reservations, right? Within team, market, and timing, right? I mean, they're always going to come down to those categories. Like you say, when you say the customers, well, that's market, right?
Yeah.
So the three categories. And if I have these little stickling little reservations, 1 or 2 is nothing. When you start adding them up, you might say, it's just too much here. It's just not worth it.
Everything. Look, our memo boils down to thesis and risks. And so the best way to think about this is that we never do a single investment that doesn't have risk. We're early stage investors. So it's always just a matter of having enough conviction in the thesis to outweigh the risks, or mitigating those risks somehow or another based on expertise or whatever. What happens when deals don't go through is that the risk column just keeps growing. And maybe the thesis shrinks or whatever it is, but
so let's go back. So we get to the process and I sit here and I go, oh, all right. I wrote the memo. We presented to the investment committee. They gave it a green light. Next step.
Term sheet.
Okay. And then the term sheet is that you must have a way you guys write term sheets with, what you want in a term sheet and all that. And I don't want to get into that right now. But
yeah.
But what happens with you give me a term sheet and I go, me and my advisors that I have, they look at it and they go, you got to be kidding me. What about this? And the valuation is that, and it should be this. And these terms that you have, these preferences that you're offering me, I mean, I can't. Who negotiates all that? How do you get to, all right, let's get to an agreement here. We put a lot of time into this thing, and I'm sure you're setting expectations all the way along, right?
The goal.
This isn't like you just kind of throw a piece of paper down and the guy's like, what? Shouldn't.
I imagine that happens. We try our best to not have that happen, because then again, it's a waste of our time, waste of your time. But yeah, we generally try to, first off, our term sheets, and especially at seed stage, you should expect for it to be NVCA standard. I mean, there shouldn't be much that deviates from what is a relatively standard set of deal terms. Back to your point about preferences or preemptive or whatever. So really, usually most of the
preferences that if the deals terms are quote standard for these days, in a seed stage, what kind of preferences are there?
Preferences broadly, there's not much. Liquidation preference specifically is almost always 1x. And then when you think about things like redemption rights or whatever, those usually don't exist in today's market. And I'm not saying anything that's like letting the cat out of the bag. Go to NVCA, download the standard term sheet, talk to your lawyer and ask them what's NVCA standard. They'll tell you. So
NVCA stands for National Venture Capital Association. Okay.
Correct.
That's where these term sheets are listed. Okay.
Yeah. And so they'll generally stick close to that. And so most of the conversations come down to valuation, and they come down to the board. They come down to how much is the fund, how much is the round for, et cetera. And most of those things go back to, if you're aligned on milestones, you're aligned on the rest of it. And so when you get to a point on term sheet and all of a sudden you're both flying past each other, then you probably messed up something earlier in the conversations.
What do you mean
about
you're aligned on milestones. Explain that.
Back to the basics of, I need X amount of dollars to get to Y point in my company, right? And if I need $5 million to get 2 more months, and it's a bridge financing, and that's totally different than I need $2 million to get 18 months to reach Y milestone. And so when those things generally are aligned, then when you get to term sheet stage, it's like, is it 2? Is it 2.1? Is it 2.3? Is it 1.9? Just nuances off the base, and you don't usually get that misaligned, but it happens. And especially if you have a lot of advisors or a lot of others.
That if you have agreement on milestones, how much money it's going to take to get to a milestone and what the milestone is and what you're going to achieve, then probably the individual terms, the bigger terms in the term sheet, they aren't going to be an issue. I think that makes total sense. That's great insight.
And even down to valuation, because again, a milestone, like I need to get to Y point. The only way to know how to get to Y point is to be honest about where you are today. And so if you're being honest about where you are today, then usually that translates into a reasonable valuation range based on that whole 10x conversation we had, however you want to look at it. But usually the conversation about milestones forces an entrepreneur and an investor to be aligned about where the business is today. Are you a $50 million company or are you a $10 million company?
That makes a lot of sense. So instead of sitting around here, what people are doing though is they're saying, that this company in the marketplace, they're getting, like you look at SalesLoft, we're in that same sort of space, and SalesLoft has a 20-time revenue multiple. Well,
Right.
we should have at least a 15-time revenue multiple. In other words, I'm arguing off of some public
Yeah.
market leader and his and his valuation. Okay, and that doesn't really make any sense. It really does come down to, if I put this money in, you're going to get to this milestone, and if you can't
Yeah.
prove to me you're going to get to this milestone or make me feel comfortable with it,
Yeah.
I'm out.
Yeah.
I'm out, and the valuation can't be any more than this. That makes
and
a
usually
lot of sense.
What we found most often, and maybe it's the set of conversations we've had, but if you really care to understand the business and really figure out not just how do you get to this milestone, but if we partnered with you, how would we help you get to that milestone? Once you've had enough of those conversations, it's usually more self-awareness about where the founder really is and where the company is, and you're usually not off by that much. So we've had plenty of conversations where we've gone in and someone said, I'm a $50 million company, and then had enough realistic conversations about where the business is to say, all right, maybe I'm more around here and one milestone away from being a $50 million company. And you're like, agreed. So let's go get you there, right? I'm fired up to go take the company to that level.
So after I get my term sheet signed off on, we negotiate it, whatever the points are, we both sign it. Then what happens?
So then it's due diligence. And that is really a matter for us, at least. Some firms do this a little differently, but we do a lot of our diligence, investment, conviction building, all of it up front. By the time we get to a term sheet and you sign it, we don't have any more like investment homework to do. We're just doing due diligence based on, is what you told us in the earlier diligence true? So did you lie about the financials, any of that stuff? And then getting the lawyers to paper up the documents. We're pulling a syndicate of other co-investors together. So if we're doing $1 million of a $2 million round,
well, it's interesting to step back. The due diligence we're talking about now, it's almost like an audit.
Yeah, it's more.
I'm not looking to discover something new. I'm just verifying that what you told me is true.
Yes, and in some cases where deal processes are going really quickly, yeah, we might say, hey, we only got to one customer call. We really like to do two. We're going to do a second customer call and due diligence. But generally speaking, most of the new information has been found and analyzed before the term sheet. And then post-term sheet is verification of all that you dug up.
And when you say then we paper our terms, okay, this is so we're creating what kind of agreement?
So you are going to create a stock purchase agreement, investor rights agreement, voting agreement, alter your charter, all that stuff.
Okay. How long does this, so that's 9 steps, if you didn't know it, okay? 9 steps, okay. So 9 steps, I go through this whole thing. Then, of course, well, let's just have 10 steps, and 10 steps is closing, right? We get together, here's all the paperwork, we all got to sign it, we all sign it, we make the funds transfer, you're funded, and I'm now a board member or whatever, we have 2 board members or whatever the seats are, off we go, right? We just we do what we agreed to. That's what we get to. How long does that take from that initial contact? Give me the sort of the mean, okay, and the fastest and the longest, okay?
The mean from initial meeting to term sheet, which is the biggest milestone in the midst of those 10 steps, is 5 to 6 weeks.
Wow.
The fastest is 2. And I guess the longest can be, I don't know, can be wildly long if you meet somebody really early. and they're not even fundraising, for instance. So it just depends. But
so it could be a year. It could be more.
It could be a year.
Yeah.
It could be a year. We prefer to build relationships with entrepreneurs over a longer period of time. So
that's amazing, though. You get this done with all of the people that are coming in, this the sea of requests. I love that. Yep, info@techsquareventures.com. I just love that. It sort of says it all. With this barrage of people coming at you and you having such limited resources, I mean, you're not a big fund, which means you don't have tons of people here pushing things around and have time to talk. You do have a wife and 3 kids, all right? So you have a life. I'm amazed you can get a deal done from initial contact to term sheet signing in 5 to 6 weeks. That's just what the environment looks like today, right?
Yeah, I mean, you at the end of the day, our job is to invest in the best companies. And so we have to be responsive to the market. And that is partly responsive to the market. The other thing I think we realize is what I've had to get good at in the last 4 or 5 years is trying to be very good at quick screens and then getting focused. So saying, I'm sure I'm missing other great deals and I'm okay with that, but I'm going to focus on this one and make sure that if it's a good one, I don't miss this one, right? And that's been really hard because the challenge when you go into this market is I don't want to miss anything. It's this FOMO effect of let me just keep every ball juggling, right? Let me just juggle all the balls, and then the reality is you don't get any of the deals because you weren't able to focus and build conviction and really understand the market and win over the entrepreneur. And so that's kind of been the challenge. So it's just been, and that's why I'm sure it's very frustrating as an entrepreneur because you'll be talking to somebody like me and then I'll disappear. And you'll be like, well, what happened to him? And the reality was there was one other that for whatever reason has taken priority. It doesn't necessarily mean it's a better deal than yours. It's just the timing is right. It's now and I have to focus on it. And so I might go into a hole for a week, but that's sort of the process. And then I'll pick the other ones back up and that kind of stuff. So that's been the challenge.
How has the environment, this has been fantastic. Okay. But how is the environment changing over the last couple of 3 years? I mean, you're doing this quite a while now. Okay. You said you've been in Atlanta almost 7 years, I think, so you've been in venture capital now almost 7 years, right?
Yeah. Like 5.5.
5.5 years you've been in venture capital.
Yeah.
You've seen when you came on board and then you see where the market has sort of moved to. Okay. Like the S&P has, more than doubled, in that kind of time frame. So you're seeing we went from a great company selling for $250 million to a great company selling for $3 billion. Okay. Things are different now. We're seeing tons of money coming in, like family offices now I'm even seeing are going into early stage stuff, right? I mean, tell me what change you see with regard to funds available. Like, and maybe another way to say it is, who are your competitors now? And I know we're all friendly sort of investors, right? We all want to get along. But you're competing for having somebody accept your money on the right deal versus someone else's money on the right deal, right? So who's showing up in deals that you go, a year ago they weren't, I didn't even know they existed. And now they're sort of showing up, and they're coming from up here. They have $1 billion in capital and they're talking to this guy who's trying to raise $3 million and they're saying, don't raise $3 million, raise $10 million.
Yeah, exactly.
Right? So is that happening now? Because that could screw everything up.
It sure can. We joke. I mean, back to the earlier part of the conversation was this guy needs money and you got money. We have to sell our money, right? So it's an interesting spot to be in, but it is the current.
We have to sell our money. That's right. That's what you got to do, right?
In these competitive situations, you got to sell your money. And I kudos to and credit to the entrepreneurs and the current market that are able to create those competitive dynamics. And I mean, like any other market, that's how you create the most efficiency. So I get all that. And I think I think there's broader concerns about back to what you've noticed in the market where the S&P has gone and the amount of capital in and what does it do to the environment to have $1 billion funds writing $10 million checks and, having individuals do things like crowdfunding, like Republic and others, where you're investing in crowd safes with very little, very little behind it, and you're taking, people's money off the street and investing it into the highest risk asset class. So there's a lot I'd love to talk about where this might end up, but we're definitely in an unprecedented market. We're definitely.
The question really is how is this affecting you?
Oh yeah. So
yeah, see, that's the key. I mean, I'm not trying to talk philosophically about, the ecosystem here, but I'm saying all this is kind of going on and people are moving. At one point when money's scarce, everybody moves up the value chain to get to lower risk deals, to park their capital that have higher returns, right? Then when money becomes like free almost, right? It moves the other way, that everybody starts moving to higher risk deals, which is your category.
Yeah.
I mean, you're in the seed stage. So you say like, oh man, I've been hanging out here and everything's great. Yeah, there's a couple of small seed funds that are 10 or 30 million and stuff. And we know those guys. Then all of a sudden, the green giant shows up, right? And you're like, what is that?
We were talking with an entrepreneur and thought we were in a really good place, and a firm, that just came in out of nowhere with very few precedent investments in Atlanta or at this stage, and offered them a term sheet. And yeah, I mean, it's happening. You're saying, how's it affecting me? It's happening to us and me all the time. That said, I think we've got two things that help us a lot. One,
what did they do differently though? What did they do differently that disrupted the entire deal?
Yeah, they have a different perspective because of what they bring to the table. So we bring this sort of enterprise go-to-market expertise, and I think we could go toe-to-toe with anybody on that front.
Okay.
I think we have a really unique offering. I worry less about that. In this case, there was a highly specific partner who had come from a firm that was the sort of growth stage version of this company and what they were building. So he just knew their market backward and forward. And when you have something that's really unique like that, makes sense for it to disrupt the cycle and disrupt the process.
Did they also change the valuation higher and offer more money?
Not necessarily.
Oh, so they stayed basically within your term sheet in effect.
Yeah, we actually they in this technical example, they issued a term sheet before we did. But the point was that it made more sense for them to go with that investor, and they also saw that there needed to be a change in the team. And we like to back the team. We don't like to kick people off teams. And so we realized this was not the deal for us. They saw a good market opportunity and wanted to make a change to the team. So, point is, we're competing with firms we've never competed with before.
Yeah, but the point that I was making that is different than what I thought would be the answer is these other people could come in, but the terms are generally going to be the same. There isn't somebody who says, you're saying we've kind of gone to an agreement that we're going to raise $3 million here and let's kind of work towards that. And somebody walks in and says, don't raise 3, raise 10, because they got so much money. It doesn't matter to them. It seems they're paying their thesis and the bets they place is just different than the way you bet on things.
Yeah. Which is 100% true. And so going back to the valuation conversations, a good chunk of that is working backwards on what matters for those funds. And when you're a $5 billion fund, the only way to even matter to those companies is not a 10x 100 million exit. It's the baseline screen for them is $1 billion exit. So for those companies that's an easy story to tell, then that makes sense. And it does get competitive. And back to your question, I mean, yeah, sure. We're certainly seeing firms come in and offer terms that are wildly out of norm, out of market, or more than the entrepreneur necessarily wanted. Truth is, though, I mean, and I hope I continue to be right about this experience, is that we've spent enough time developing a relationship with our entrepreneurs, understanding what the milestones are, the needs of the capital, and how we are uniquely positioned to help, that we've been able to win in those situations where a valuation might be higher, but we're a better partner. And so if that ends up being the case and we're not the highest valuation, hopefully we're the best partner, and that's how we win those deals.
I think one of the things that we talked about, and I kind of call this to an end here, I think what's most important is when you said a lot, you started this by saying a lot of people that come to us for venture capital funding are not venture capital deals. All right. And I think if we can end with this, I mean, and it came, so what makes for a venture capital deal? And I think you came up with two criteria.
Yeah, I would say off the top of my head, it's getting to a certain level of scale. And this is not because it's cool or fun or exciting, but it's back to everything you highlighted, Charlie, that our investors expect something from us. And they expect 20% type IRR type returns. And so for that to happen, we have to invest in companies that generate at least a 10x return, 20 to 30x ideally. And they have to do it in a 5 to 7 year time frame because we have a 10-year fund cycle. So that's the highest level metric. That means a lot of things when you're an entrepreneur, but it goes back to team, market, and timing. You've got to be a unique team in a large enough market where the timing means it's going to happen very fast, and you're going to be able to grow and scale your company really quickly. So that, and that's you can build a great business without one of those things aligning, and then you just need to find capital from alternative sources, which is not as easy as it should be, unfortunately. But there's more and more options now than there ever has been. But that's when you're asking yourself, am I a venture opportunity? It comes down to, is it a big enough opportunity that I can reach fast enough?
Right. Another way that we put it earlier on, I thought was interesting, is this is when we talked about the dry cleaners. That there's this that one is there isn't one person coming in at a time, but there's this line out the door. So the first one is, have you achieved, in effect, market pull? Now, the market is just kind of, they're pulling you along. And then the second question you said, okay, do you have a solution that could take advantage of 1,000 people waiting for their suit to be cleaned? Okay.
Correct.
And if you don't have that, it doesn't matter how many people are out there. If you can only handle one at a time, I'm not interested. So there's the demand plus the solution to capture the demand. Okay. And that's another high level thing. Then the question is, will it ever get to be $100 million business and all that? I agree with that, because if everybody's buying it for a penny, there aren't enough people to have the pennies add up to anything that's worthwhile. Right. So
the other way I'd put it is, what's the accumulating value that you grow in your business aside from landing one customer at a time?
Yeah.
So that might look like a network effect. It might look like AI, where your AI gets better as you process more data. There's a variety of versions. And unfortunately, they all correlate to a buzzword in VC land. And so it looks sort of like silly. Oh, network effects and AI. But the reality is that those business models do generally grow exponentially, because you can capture more of that demand faster at later stages than you could earlier, because your solution has grown, it's more effective or efficient, or because the value in that business is higher. And so, it's a really rare model to not just grow 300% year over year, but grow with a curve that grows, you grow faster as you get later into the business, and it's hard to do.
How many on Fund 2, how many, you said that you were talking about doing 20 to 25 investments, initial investments. What kind of progress have you guys made on that thus far?
Yeah, we are 7, actually 8 now, 8 investments into Fund 2. So a third of the way through the fund in terms of investments.
How long do you have in your own minds, okay, as to when you need to sort of finish up that initial round of investing, so that as soon as you do that, you start looking to Fund 3, right? I mean,
yeah, exactly. I would say,
you guys are like sharks, you got to keep moving. And if you,
well, and it's funny because we talk about fundraising, but Blake certainly could speak to this more than I could. But we've got a fundraiser.
Well, you're gonna have your turn, okay?
Oh yeah, can't wait. We've got a fundraise too, which is as challenging as ever. But yes, at our current pace, we're a third of the way through. I think we want to continue that pace. So give it 2 more years, roughly 2.5, 3 more years of initial investments.
Okay.
And then as our current companies go to raise follow-on funding, we'll be doing follow-ons as well. So
yeah, but you'll be doing also, when you get to that stage, you've got to be raising Fund 3.
Yep.
You've got to be raising Fund 3. You'll be into that probably within 18 months. no more than 24 months that you're out there again.
That's right. That's right.
So I wish you that $1 billion or $2 billion company in your back pocket so that you can go and say, look, we found one and we know how to find them all day long, right?
And we're going to do it again. Yeah, that's right. We got to provide our own evidence, right? Of our own product market. So,
well, Scott, thanks for this time. This has been fantastic.
Thank you, Charlie. This has been great.
Yeah, I think that you going through that process, those 10 steps, if you will, I think are going to be very helpful for entrepreneurs. But I also think that just the general discussion that we had, there's bits and pieces that they'll pull out from that they'll find to be useful. And hopefully when they come to you, they'll be, in fact, really qualified. And you'll be writing not only one-pagers, but you'll be writing whole memos. Okay.
I think there's, I guess just a last thought. I think there's a lot of overlaps between the way you manage a sales process and the way you manage a fundraise. Back to your point, Charlie. Do you have a qualified buyer? Is your internal champion, is he empowered with budget, right? Can he write checks, right? Can he convince his partnership to do this deal or she? You got to do all the same level of homework. I encourage people to create a pipeline and define stages and move funds upward and back as you go through the fundraising process. But yeah, good luck to any entrepreneurs doing it, and would love to talk to anybody. As you can hear from this conversation, we have a lot of conversations, and then we good fits. But I'm always, that's why I got into this business, is I love working with entrepreneurs. So would love to talk to anybody that wants to chat.
All right. Well, I'll just close this out and then I'll say goodbye to you if you just hang on for just a second.
Yeah.
All right. Thanks for joining the Charlie Paparelli Show. Boy, that was a great conversation with Scott, and there's so much to learn from that. There are the 10 steps in his process that every VC will have. And I like how we ended and said, it's just like selling to your customers. Now you're selling to a VC, and it's the same kind of process. Don't forget to ask the VC, does he have budget? Does he have money to invest? Some of them don't. They've already invested out, but they'll talk to you anyway. So don't waste your time. Move on. Anyway, thanks for joining us. Please subscribe at paparelli.com so that you don't miss an episode. And I appreciate Scott doing all that he's done and time that he spent with us and the expertise that he's shared. Happy New Year. Take care. Bye-bye.